Welcome to the Capmatcher podcast, the podcast on your way to funding, digital matchmaking for early stage startups and investors on capmatcher.com. Hi, this is Max from Capmatcher.com. Capmatcher matches investors with currently more than 1,000 manually screened early-stage startups with more than 1 billion capital demand. Today, we are going to talk about the venture capital basics. This episode is part 1 out of 6 episodes regarding the most important technical terms and definitions for investors and startups. Now, if you have tried to dig into the topic of venture capital, then you have probably noticed that there exist many confusing and technical terms regarding this topic. So we from Capmatcher.com thought that it might be the best way to simply record a podcast series about the topic. There's just no worse situation than having to talk with an investor without having the right knowledge for the conversation. And as you might know, in these conversations that should ultimately lead to a deal between you and the investor, there is just nothing more important than talking at eye level to each other. And an important contribution to this is that both sides possess the required knowledge about this topic of interest. So enough said, here are the venture capital basics. The first notion I want to talk about is private equity, or private off-market capital as it's called sometimes. Private equity in the narrower sense basically means shares of a company which are not traded on a public market. And when I talk about a public market, in this case, we're talking about the stock exchange. In a broader sense, private equity refers to the entire industry engaged in the purchase and/or sale of non-exchange traded shares. And typically, private equity investors are regarded as capital providers for companies in later stages, when the companies have already exceeded a significant turnover and profit threshold. The next notion is venture capital. Venture capital, or sometimes it's also called risk capital, is a subset of private equity. As you may know, startups or companies in the funding phase can also sell corporate shares, of course. The difference in the notion of venture capital is not sharply defined, but specifically means the share in private equity consisting of early stage companies not yet generating revenues or profits, or companies which produce positive figures for the first time but are still in the midst of their growth phase. The third notion in this list is venture capital companies, also VC companies, or in short, just VCs. Venture capital companies, and that obviously accounts also for private equity companies, are companies founded for managing one or several risk capital funds. Talking about risk capital funds, venture capital funds, and again, in principle, the description also applies to private equity funds again, are pools of capital set up by venture capital companies. Subsequently, investors can acquire shares in that fund. Usually, these funds have the legal form of a limited partnership in which investors then acquire shares. Ultimately, it is precisely this limited liability company that buys the shares in a startup provided a deal takes place. Now, as you can see, it's very important to distinguish between a venture capital fund and a venture capital company. The company controls the fund and invests in startups on behalf of the fund. By contrast, the fund actually invests in startups like yours, for example. The investors who acquired shares to the fund can be, for example, institutional investors, family offices, or also high net worth individuals. Now you should have a pretty good overview over the basics of venture capital. In the next episode, so that will be episode number 2 of our 6-part series, we're going to take a look at the venture capital investors of startups. So what kind of investors you might come across on your way to funding. Thanks for listening to the Capmatcher podcast. Did this episode make you curious? Then visit our site at capmatcher.com.